Welcome to Wealth and Means, advice dressed up like hard work.
Episode 29. Let's get into it.
This week we're tracking patient capital, the kind that builds reactors, not renders. An Amazon-backed nuclear startup priced its IPO this week and shot up 27% on day one. Japan's interest rates are the highest they've been since 1995. And for the first time in history, the median American buying their first home expects to do it at 40. We'll walk through all of it in what you didn't see in the news. Then wake up ready. The single most important week of the first half of the year hits Tuesday through Thursday. The FOMC decision, Q1 GDP, PCE inflation, the Employment Cost Index, and 4 of the 7 largest companies in the world reporting earnings all land within 48 hours of each other. We'll tell you exactly what to watch for in each one. Knowledge Bomb this week is a deep dive into what leveraged ETFs actually do to your money over time, and why the math behind them isn't what most people think. The Humor Me segment takes one look at the NFL draft and finds the most quietly subversive economic metaphor of the week. The Greater Debate brings Niall Ferguson and Darren Acemoglu into the same room to argue about whether being in the Commonwealth actually made you rich. And Let's Invent Again goes back to 1869, to a 22-year-old with a better idea about how to stop a train.
Patient capital doesn't announce itself, it just shows up later in places nobody thought to look.
Let's go.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee. A quick thank you to our sponsor, agentweekly.ai, chronicling the absurd, the ambitious, and the algorithmically challenged corners of the AI agent economy. This week opened with a number that stopped a lot of people mid-scroll: $1 billion, raised in a single day for a company that makes nuclear reactors. On Thursday, X Energy, backed by Amazon and founded in 2009, priced its NASDAQ IPO at $23 per share, 21% above its marketed range, and surged 27% on its first day of trading. That makes it the largest nuclear public equity offering in history. Not the largest tech offering. Not the largest of the year, the largest nuclear offering. Ever. Here's what the company actually does. X Energy builds the XE100, an 80-megawatt high-temperature gas-cooled reactor that uses helium and pebble-sized fuel capsules instead of traditional rods. The design is smaller, safer, and modular. Amazon has already committed to purchase up to 5 gigawatts of X Energy's output by 2039. The company has 144 reactors on order as part of an 11-gigawatt pipeline. That's not a promise. That's a purchase order. The texture of this story is what makes it worth pausing on. The data center build-out driving AI compute demand requires enormous, reliable baseload power, the kind that can't be switched on and off with the weather. Hyperscalers like Amazon can't rely on intermittent sources for mission-critical uptime. Nuclear is the only carbon-free energy source that delivers both scale and reliability, and the small modular reactor format makes it deployable near the actual load, not just near a river or a coastline. What it means: this IPO legitimizes SMR technology at the capital markets level. It signals that institutional investors are willing to buy the sector directly, not through utility proxies, but through direct exposure to the builder. The second-order play is in uranium. Spot prices have been quietly rising on new demand projections, and nuclear fuel fabricators are the sleeper beneficiaries no one's naming yet. The attention reason: X Energy priced and began trading April 24th, and the 27% first-day surge generated enough noise in capital markets circles that even people who weren't watching the IPO calendar noticed.
When Amazon writes a check that big, it's not a bet, it's a contract with physics.
That same pattern of patient capital shows up in one of the oldest economies in the world, but in a way that's just now starting to matter. Japan's 10-year government bond yield slid to around 2.38% this week, and that's significant precisely because it's falling after years of rising. The Bank of Japan has kept its short-term rate at 0.75% as of its March meeting, the highest it's been since September 1995. This is a country that had negative or near-zero interest rates for 2 decades. What changed was a person. Prime Minister Sanae Takaichi came into office championing what analysts are calling Sanenomics, a fiscal framework designed to boost middle-class spending and escape Japan's demographic trap of labor shortages and stagnating productivity. The goal is to reflate the Japanese economy through domestic consumption, not just export-led growth. If that sounds familiar, it's a spiritual successor to Abenomics, but with higher rates, real wage growth, and a central bank that's finally normalizing after decades of suppression. Here's what the texture looks like from the ground. Japanese nominal wages grew 3% year over year in 2025 for the first time in a generation. Companies that had spent years managing a deflationary consumer mindset are now seeing domestic demand they didn't budget for. The yen, which was a major source of global macro volatility in 2024, has been stabilizing as Japan's rate differential with the rest of the world narrows. The reason this matters beyond Japan: Japan is the world's largest creditor nation and one of the biggest holders of U.S. treasuries. As Japanese rates normalize, Japanese institutions may begin repatriating capital to invest domestically. That unwinding is a slow motion structural shift in global fixed income flows. You won't see it in a headline, but you'll see it in Treasury auction demand over the next 18 months. The attention reason: the 10-year JGB yield, making news this week as it slid on Middle East uncertainty, brought the broader Sanaenomics story back into view, and the Bank of Japan is expected to signal its June policy intentions within the next few weeks.
When the world's largest creditor starts wanting its money back, everybody's borrowing costs inch upward, quietly for a long time.
Which brings us to a data point that's technically about real estate, but actually about something much bigger. According to both the National Association of Realtors and a new BMO survey released this week, the median age of a first-time homebuyer in the United States is now 40 years old. In the early 1990s, it was 28. That's a 12-year shift in a single generation. And it's not just when people are buying, it's how and why they're doing it. 65% of current buyers say they expect their first home to be their forever home. They're not buying a starter house with plans to trade up. They're buying the house they intend to stay in for decades once. The old pattern, buy young, build equity, move up, has been replaced by wait until you're certain, then commit once. What's driving this is arithmetic. 3/4 of Americans with caregiving responsibilities cite housing costs as a major source of financial anxiety. Nearly 7 in 10 say they're prioritizing childcare or education savings over a down payment. The monthly payment on a 30-year fixed at current rates on a median-priced home is now comparable to renting in most major metros. And that's been true long enough that an entire cohort restructured their life plans around it. Here's the second-order implication that doesn't get discussed enough. A society where first-time buyers are 40 is a society where housing wealth accumulation starts 12 years later than it used to. The compounding that would have begun at 28, equity growth, appreciation, leveraged exposure to an appreciating asset, is delayed by more than a decade. For an entire generation, that's not just a personal finance decision. It's a structural shift in how household wealth gets built.
The starter home wasn't just a house, it was the first engine of middle-class compounding, and it's now running 12 years late.
That same geographic and structural reshaping is happening in global trade, and the story is surprisingly specific. The tariff landscape for Southeast Asian manufacturing nations has, after 2 years of volatility, largely settled. Vietnam and Thailand have landed at reciprocal tariff rates of roughly 19 to 20% from the U.S., with carve-outs for products the U.S. doesn't domestically produce. That's survivable, and both countries are now leaning into the positioning that uncertainty itself created. ASEAN's smartphone and laptop exports to the U.S. gained measurable share through 2025 as supply chains that had been anchored in China began redirecting. India picked up smartphone assembly. Vietnam picked up laptop components. The reshuffling that started with COVID and accelerated with the first wave of tariffs has now hardened into a structural reorientation that analysts expect to persist regardless of future political changes in Washington. Here's the texture. This isn't just about factories moving. It's about the full production ecosystem: suppliers, logistics networks, specialized labor pools, shifting and then self-reinforcing. When a second-tier supplier moves to Vietnam, it makes Vietnam more attractive for a third-tier supplier. The agglomeration effects of manufacturing compound, just like financial returns. The second-order implication most people miss. As ASEAN manufacturing deepens, it increases those economies' exposure to U.S. consumer spending cycles. A U.S. recession now lands harder in Ho Chi Minh City than it did 5 years ago. Diversification has made some economies more resilient, but it's also tightened a new set of dependencies that didn't exist before.
Uncertainty is its own kind of tariff. The moment it settles, investment follows the cheapest survivable path.
From trade routes to trade governance. Something unusual happened last month, and it didn't get the coverage it deserved. For the first time in the World Trade Organization's 30-year history, a ministerial conference was held on African soil. MC14, the WTO's 14th ministerial, convened in Yaoundé, Cameroon, in late March, with over 4,000 delegates from 166 member countries. That's not just symbolic, it reflects a deliberate political calculation about where the center of gravity in global trade is slowly shifting. The outcomes were partial. 66 members signed a formal agreement on electronic commerce, a real deliverable after years of negotiations. But fisheries subsidies reform and intellectual property moratoriums were deferred again, kicked back to Geneva. The most substantive negotiations on the things that matter most to developing nations. IP flexibilities, food security safeguards, fair agricultural subsidy rules remain unresolved. Here's the texture of what Yaoundé actually represented. Cameroon's trade minister pushed hard for a declaration formally acknowledging the asymmetric impact of rising tariffs on smaller economies with limited fiscal buffers. That language made it into the conference conclusions. It's a first, not a binding commitment, but a formal WTO acknowledgement that the existing rules weren't written for the economies most exposed to today's disruption. The bigger implication is about leverage. Hosting the ministerial shifts Africa's perceived status inside the multilateral system, from recipient of trade rules to co-author of them. Future trade negotiations will feel different when they've already convened in Yaoundé. The Peterson Institute ran a piece this week asking whether MC14 was a failure, and that framing, sharply disputed by African trade ministers, restarted the conversation about who gets to set the agenda.
Who hosts the meeting is who sets the table, and who sets the table has more power than the agenda ever shows.
With direct links to Ghana, Togo, and Nigeria. Passenger flights between Colombian cities and major African hubs are being actively explored. According to UNTAD's April trade update, South-South trade grew roughly 9% in the last full data year, outpacing the global average by a wide margin. The stronger performers are in East Africa and parts of West Africa, where export diversification beyond primary commodities is accelerating. The critical mineral angle is part of this. Latin America's lithium and copper deposits, combined with Africa's cobalt, manganese, and rare earth positions, create a potential supply chain for the energy transition that doesn't route through North America or Europe. The texture here is that this kind of corridor building is slow and expensive. Ports, logistics, payment systems, currency agreements, and most of it will be invisible for years before it's suddenly obvious. The countries betting on it are betting on 10-year infrastructure timelines, which is exactly the kind of patient capital thesis that doesn't generate headlines until the payoff shows up. The second-order implication: if this corridor matures, it reduces both blocs' dependence on northern demand and northern financial infrastructure. That's a structural shift in how global capital flows, and it's one of the underwatched geopolitical stories of the decade.
Two continents that spent a century exporting to the same customers just started wondering whether they could export to each other.
Staying in the southern hemisphere, but shifting to technology. This week, China's DeepSeek released a preview of its V4 model, the first major update since the R1 model stunned global markets in early 2025. The V4 comes in Flash and Pro versions, both targeting coding, reasoning, and agentic tasks. The context window has been expanded to 1 million tokens, meaning entire codebases or long documents can be processed in a single prompt. But the more interesting detail isn't the benchmarks, it's the hardware. DeepSeek explicitly engineered V4 to run on Huawei's Ascend 950 chips, combined in what Huawei calls a supernode cluster architecture. The R1 model, which caused NVIDIA's stock to drop 17% in a single day, ran substantially on NVIDIA hardware. V4 doesn't. Here's why that changes the story. The first wave of Chinese AI efficiency was about doing more with less, compressing model performance to run on fewer, cheaper chips. V4 is about doing more with specifically Chinese chips. That's not an optimization story. That's a supply chain sovereignty story. China is building an AI stack, from hardware to model to deployment infrastructure, that doesn't depend on US export controlled components. And like DeepSeek's earlier releases, V4 is open source, the same playbook that turns a technology release into a standards play. The second order implication for US investors: if China's domestic AI stack becomes self sufficient, the primary leverage the US has in AI competition, export controls on advanced semiconductors, weakens over time. V4's Huawei integration is the clearest proof of concept yet that China is on that path, and it deserves more attention than it's getting in a week crowded with earnings previews.
Open source isn't charity, it's a standards play with a 10-year payoff.
Now for something that signals a quiet shift in how the creator economy values talent. On April 7th, Pixart, the AI-powered design platform with 150 million monthly users, launched a monetization program that challenges how most platforms have historically decided who gets paid. Their Earn with Pixart program pays creators based on audience engagement: views, shares, comments, reach, not follower count. No invite list, no minimum audience size. Anyone who creates original content with Pixart tools, posts it to their social channels, and drives engagement is eligible to earn. That sounds like a small announcement, but it represents a structural challenge to the follower threshold model that has governed creator monetization since YouTube pioneered it. On every major platform, TikTok, Instagram, YouTube, monetization is gated by scale. You need to be big enough before the platform shares revenue. Pixart's model says the relevant unit of value is the content itself, not the account that posts it. Here's the texture. Adobe, Canva, and Pixart are all competing for the design tool layer of the creator economy, a layer below the distribution platforms. By paying for creative output rather than creative input, Pixart is betting that revenue participation is the new feature that retains creators. A creator who can earn from 2,000 engaged followers has entirely different platform loyalty than one who feels locked out until they hit 10,000. The second order implication: if this engagement-based pay model gains traction at the tool layer, it weakens the value proposition of follower-gated distribution platforms. The compounding advantage of scale, which is the reason most creators stayed on existing platforms even as conditions worsened, starts to erode. Small creators have a viable alternative path. That's a structural change, not just a feature update.
Every gate that falls in the creator economy means one fewer reason to wait before starting.
Now for the story that feels like it belongs in a different decade. Scientists published results this week showing that a new plastic film can physically destroy viruses. Not neutralize them chemically, but physically rupture them, using microscopic surface pillars that stretch viral particles until they burst. The film is flexible enough to coat everyday surfaces: door handles, elevator buttons, countertops. The mechanism doesn't use antimicrobial chemicals that can degrade over time or generate resistance. The virus touches the surface, gets drawn across the pillar geometry, and tears apart, like a soap bubble on a thumbtack, but engineered at the nanometer scale. The approach is particularly effective against enveloped viruses, the category that includes influenza, SARS-CoV-2, and RSV. And crucially, the pillar geometry can be tuned by adjusting manufacturing parameters, which means the same production line could theoretically generate films targeting different viral families. Here's the texture that makes this story special. Unlike chemical antimicrobials, this technology can't be beaten by pathogen evolution. There's no active compound for the virus to develop resistance to. The destruction is purely mechanical, which means, in principle, this is a surface technology that doesn't expire or lose efficacy over time. The second order implication: hospitals, airports, and schools currently spend billions on cleaning protocols that are partially effective and require constant labor. A passive, durable, non-degrading surface technology doesn't replace cleaning, but it changes the cost structure of infection control fundamentally. The publication landed in ACS Nano in the third week of April and has been gaining traction in science media, but hasn't crossed into mainstream coverage yet.
We've been trying to out-chemical biology for decades. It turns out geometry might win.
And one more before we close the segment out. This one for the genuinely curious. 200 years ago, scientists first noticed that dolomite, a mineral that makes up entire mountain ranges and forms the bedrock of dozens of coastal oil reservoirs, couldn't be grown in the laboratory. Geologists could find it everywhere in nature, some deposits hundreds of millions of years old, but every attempt to synthesize it under realistic conditions failed. The mineral required time and geological pressure that couldn't be replicated. It became known as the dolomite problem, one of the longest standing unsolved puzzles in earth science. This week, a team published results showing they've finally cracked it. Using precise electron beam pulses combined with molecular simulations that mapped where the crystal growth stalls, they grew dolomite in the lab at conditions approximating the natural environment. The key insight: the crystal doesn't fail to form. It jams at specific defect points, like a zipper that catches at a particular tooth. Targeted energy pulses cleared those jams without disrupting the surrounding crystal structure. 2 centuries of failure, solved by mapping exactly where the process got stuck. Here's why it matters beyond pure curiosity. Dolomite plays a role in the marine carbonate cycle, which is one of the major long-term sinks for atmospheric CO2. Understanding precisely how it forms could meaningfully refine models of deep-time carbon cycling and improve projections of how the ocean's carbon sink behaves over decades. For the oil and gas industry, which has spent decades modeling dolomite reservoirs imprecisely, because the formation chemistry was unknown, this gives engineers a better physical model of the rocks they're drilling through. Better reservoir models mean better recovery efficiency. The research published April 22nd and initially surfaced in geochemistry journals, but the story of a 200-year-old scientific puzzle being resolved is exactly the kind of thing worth keeping in view.
200 years of failure, solved by figuring out exactly where the crystal gets stuck.
Stepping back across the full set this week, a few patterns are worth naming out loud. The first is that patient capital is being rewarded. In nuclear reactors, in Japan's 30-year yield normalization, in the South-South trade corridors that took a decade to become visible. The second is that platforms of all kinds, trade platforms, creator platforms, multilateral institutions, are being rebuilt from places and communities that were previously excluded from setting the rules. And the third is that the most durable technologies this week aren't the fastest or the most impressive on paper. They're the ones built on physical or mathematical principles that can't be negotiated away or mutated around. That's what you didn't see in the news. Now let's wake up ready. The week ahead is one of those weeks where the data doesn't just update the narrative, it might rewrite it entirely. Between Tuesday and Thursday, you'll have the FOMC decision, the first estimate of Q1 GDP, PCE inflation, the employment cost index, and 4 of the 7 largest companies in the world reporting earnings. Let's walk through each one with exactly what to watch for. Not the event itself, but the signal inside it.
Tuesday and Wednesday, the Fed.
The Federal Reserve wraps its April 28 to 29 meeting on Wednesday afternoon. The federal funds rate is currently at 3.50 to 3.75%, unchanged since March. A hold is the overwhelming consensus. Futures markets are pricing it above 98% probability. That's not the story. The story is Powell's language at the 2:30 p.m. press conference. Specifically, watch for whether the statement uses more work to do versus proceed carefully. Those aren't interchangeable. One is directional, the other is neutral. More critically, watch for whether any dissenting votes appear in the statement. Governors Waller and Bowman have been the most hawkish voices on the committee. If either dissents, pushing for a higher rate, not a cut, that tells you March's unanimous statement was a compromise, not a consensus. What's already priced? The market currently has roughly 1 cut by September at 55 to 60% probability. That's the baseline. If Powell turns even slightly hawkish, that September probability drops toward 40%, and the 2-year Treasury, currently near 3.85%, reprices toward 4.1%. That cascades into regional bank valuations and floating rate consumer debt costs quickly.
Thursday morning, the data triple header.
April 30th at 8:30 a.m. Eastern brings 3 simultaneous releases that essentially define the macro picture for the rest of the summer. Q1 GDP first estimate, March PCE deflator, and the employment cost index. On GDP, consensus sits at 2.6% annualized. That number's already in market pricing. What moves markets is a miss below 2.0%, which would signal that tariff-driven demand shock is materializing in the real economy faster than models predicted. If that happens, watch small-cap consumer discretionary. That's the asset class most leveraged to domestic spending, and it's the first to reprice when the soft landing narrative starts to crack. On PCE, core PCE expected around 2.7% year over year, the Fed's own projection and already baked in. The number to actually watch is services PCE specifically. Services inflation has been running at 3.2 to 3.5%, well above target. If it accelerates to 3.6% or higher, that's evidence that wage-driven inflation isn't normalizing. Watch TIPS break-evens, currently around 2.3%, and watch the dollar against emerging market currencies. Both reprice fast on a services PCE surprise. On the employment cost index, consensus is 3.8 to 4% annualized. The prior print was 3.9%. If it comes in above 4.5%, that's a wage reacceleration signal, and it pushes the Fed's September cut to December or later. The second-order consequence, floating rate consumer debt stays elevated longer, and consumer staples stocks start functioning as a defensive hedge. That's a quiet rotation that begins the moment the number hits.
Wednesday evening, big tech.
Microsoft, Amazon, Meta, and Alphabet all report Wednesday after the close. Apple follows Thursday. The shared question across all 4 Wednesday reports is whether AI capital expenditure is generating commensurate revenue growth and what guidance looks like for the rest of 2026. Here's the specific signal. Don't watch for revenue beats. Those are already priced in. Watch for any language from Microsoft or Amazon indicating that CapEx plans are being revised downward or deferred. The market has built in an assumption that AI infrastructure investment continues to accelerate. If any one of these companies shifts from aggressive investment to measured investment in their guidance language, even just tone, the secondary effect lands in semiconductor equipment stocks. Companies like Applied Materials and Lam Research are 2 to 3 steps downstream from data center CapEx, and they're the first to reprice when the investment narrative shifts.
And one more thing to track heading into the weekend.
The Cerebras Systems IPO, targeting a May NASDAQ listing under ticker CBRS, is expected to begin its institutional roadshow this coming week. The company filed its S-1 on April 17th with a $23 billion valuation target. The wafer-scale chip at the center of the business has 4 trillion transistors on a single wafer and claims 21x performance over comparable NVIDIA hardware at 1/3 the cost and power. The OpenAI supply agreement is valued above $10 billion. Watch where the institutional book builds relative to that $23 billion figure. If the offering gets meaningfully oversubscribed above that level, it signals real institutional appetite for a non-NVIDIA compute alternative, which is a structural narrative, not just an IPO. What's priced in the broader market? AI hardware diversification is already a theme. Small and mid-cap tech has been running. Cerebras going public is the first direct vehicle for that bet. If it prices above range, it's specifically bearish for NVIDIA's pricing power in the inference segment. Not training, where NVIDIA still dominates, but inference, which is where most enterprise AI deployment actually lives. My personal watch for this week, of everything dropping Thursday morning, the one that's most asymmetric and least discussed is services PCE. Core PCE at 2.7% won't surprise anyone, but if services PCE comes in at 3.6% or above, the Fed's path to cuts gets materially more complicated in a week when the market is already watching Powell for any hawkish signal. It's the quietest number in the most crowded week of data, which is exactly what makes it the most important surprise of the next 72 hours.
And that is how you wake up ready. There's a product in your brokerage account that looks like a shortcut. It's not. Let me explain exactly why and exactly when it could actually work. It's time for the knowledge bomb. Imagine an index that goes up 10% on Monday and down 9.9% on Tuesday. You're back to where you started, flat. But a 2x leverage product tracking that same index goes up 20% on Monday and down 18.18% on Tuesday. You're not flat. You're at 98.18%. You just lost nearly 2% while the underlying index made nothing. That's called volatility decay or beta slippage. And it's the structural cost embedded in every leveraged ETP, every 2x or 3x product, the moment you hold it for more than a single trading day. Here's the math, and I promise this is worth staying with. The daily return of a leveraged product over time approximates as the leverage multiple times the index return minus a decay term equal to the leverage squared minus the leverage divided by 2 times variance. The more volatile the market, the bigger that second term gets, and the harder it works against you. A 3x product doesn't double the decay of a 2x product. It roughly quadruples it. The exponent matters more than the multiple. ULPIX, the oldest surviving 2x leveraged S&P 500 product dating back to 1997, tells you what compounding over a full market cycle actually looks like. Over roughly 28 years, it posted an annualized return of about 8.74 to 9.05%. The S&P 500 itself returned approximately 8.98 to 9.53% annually over the same period. The 2X product across a full cycle with real crashes in it barely kept pace with the unleveraged index. That's not a bad fund. That's the math. Twice the volatility, roughly twice the maximum drawdown for annualized returns that came in slightly below the plain index. SSO, a more recent 2X product launched in 2006, tells a better story, partly because it launched before the 2008 crash and survived it, catching the long post-crisis bull market. Annualized returns in the 14 to 19% range depending on your endpoint. UPRO, the 3X version launched in March 2009, tells the most favorable story possible because it launched at the bottom of the financial crisis and rode the longest bull market in modern history. Simulated backtests show what a 3X product would have done in 2008, a drawdown of 96 to 99%. The fund didn't exist then. That timing isn't a coincidence. There's another cost most people don't model: financing. These products maintain their leverage through swap contracts priced off short-term rates. With SOFR currently sitting around 3.6 to 3.8%, the financing drag on a 2X or 3X product is estimated at 6 to 12% annually in carry costs alone. During the 2009 to 2021 zero-rate era, that cost was nearly invisible. It isn't anymore, and it's running at rates that would have looked catastrophic to anyone holding these products in the rate environment we're actually in right now. The regulatory picture agrees with the math. The SEC and FINRA have explicitly stated that leveraged ETPs are designed for short-term tactical use, not buy and hold portfolios. The probability that a 2X leveraged fund outperforms the unleveraged index declines with holding period, roughly 50% at 1 year, approximately 35% at 10 years. As holding period increases, the compounding math increasingly works against you. So when do these actually work? In sustained low volatility uptrends like the post-2009 decade, specific risk-on windows, a leveraged product can compound dramatically ahead of the index. And in tactically managed allocations using trend filters like a simple 200-day moving average rule to exit when volatility spikes, backtests show meaningfully improved outcomes. The key word is tactical, not core, not set and forget. The deeper insight here isn't that these products are dangerous. It's that they are exactly what they say on the label, leveraged to the daily return. And most investors holding them are implicitly betting on the path, not just the destination. In markets that trend, the path is friendly. In markets that chop, the path is a tax. Understanding which one you're in is the whole game. And right now, in a rate environment where the financing cost is real, that question matters more than it has in years. And that's the knowledge bomb.
You know what nobody saw coming in the NFL draft this week? 9 offensive linemen taken in the first round. 9. Not wide receivers, not quarterbacks. 300-pound men whose entire job description is to prevent bad things from happening to someone more famous than they are. Humor me. The sports media had a minor breakdown. Where are the skill positions? And I get it. Nobody wears an offensive lineman's jersey to a sports bar. Nobody quotes their stats at Thanksgiving. The line is just there, silent, enormous, and completely holding everything else together. Which is exactly how I feel about the energy infrastructure story. We spent 3 years obsessing over the AI apps, the glamour positions, the Heisman Trophy winners of the software cycle. And this week, Amazon-backed X Energy raised $1 billion for small modular nuclear reactors. Not a flashy model, not a breakthrough interface, a physical container that reliably makes electricity for 40 years. The trench economy is here. The market has apparently figured out what every offensive coordinator already knew. Without protection, the quarterback doesn't matter. The NFL just drafted 9 men to make sure the ball gets thrown correctly. Capital markets just paid $1 billion to make sure the data center stays on. Protection is unglamorous. Protection is also apparently exactly what the economy needs right now.
There are debates that stop your scroll, and there are debates that clear the dinner table. It's time for the greater debate. A room has 2 lecterns, behind them a whiteboard, half erased. Someone wrote legacy at the top and ran out of conviction. A few dozen chairs, all occupied. Nobody's talking yet. The question has been on the board long enough that it feels like a verdict waiting to be read. 2 men walk in, Ferguson first, Asimoglu follows. He doesn't look at the board. The moderator states the question and disappears. Whether Commonwealth membership was net economically meaningful to its members. No applause. The question is already too old for enthusiasm. Ferguson steps to his lectern. He doesn't open with a definition. He opens with a claim. Everything you call domestic institutions, property rights, legal tradition, arm's-length contracting, impartial courts, was transmitted through the imperial network. The Commonwealth didn't invent prosperity. It carried the infrastructure for it. Silence. The room is waiting to see if this is a history lecture or a real argument. The 21% lower trade costs between Commonwealth members aren't symbolic. They're structural. Common legal familiarity, shared language, diaspora networks that move capital and contracts faster than any formal bilateral agreement. Australia, Singapore, Malaysia, they didn't just inherit institutions. They inherited a global commercial infrastructure that continuously reinforced those institutions for decades. You can't separate the thing from the network that sustained it. Acemoglu doesn't rush. He looks down at his notes, then he looks up. Australia, $64,604 per capita. Now consider Jamaica, $7,020. Pakistan, $1,479. All Commonwealth members, all with access to those 21% lower trade costs, all beneficiaries of shared legal tradition. He pauses. The room waits. The dispersion is too large. If the Commonwealth premium were real and structural, it would compress that gap. What it can't do is coexist with it indefinitely and still be called the explanation. What explains the gap isn't the network. It's what was underneath the network before anyone joined. The nature of the colonial institution itself, whether it was settler or extractive, whether it built state capacity or stripped it. Australia and Singapore got administered bureaucracies and protected property rights. Jamaica and Pakistan got extraction-oriented systems designed to move value out, not build it in. The Commonwealth inherited both and called them the same thing. A few heads tilt. Ferguson doesn't concede. He meets it. The extractive cases, I'm not disputing the heterogeneity. I'm disputing the counterfactual. The question isn't whether Jamaica and Australia had identical outcomes. The question is whether Jamaica would have done better outside the Commonwealth than inside it. The membership didn't create the disparity, but it gave continuous members preferential access to capital, markets, and commercial norms, even when those members were struggling. Pakistan suspended membership and eventually returned. Why? Because the network had value. You don't go back to something that didn't help. Acemoglu shakes his head. Not disagreement exactly, more like watching someone solve the correct problem with the wrong variable. India, continuous member. Growth acceleration begins in 1991, not in 1947, not in 1965, not in any year that maps neatly to Commonwealth engagement. 1991, when they liberalized their capital account, opened to foreign investment, and built the export services sector that became the IT industry. The Commonwealth didn't cause that. Policy change caused that. Ireland is another case, not a member, one of the wealthiest economies in Europe. Ferguson interrupts, gently but immediately. Ireland is a special case, and you know it. EEC accession fundamentally altered Ireland's institutional context in ways entirely separate from the Commonwealth question. Using Ireland to argue against membership value is like using Switzerland to argue against the value of NATO. You're proving a different point. That lands. A few people in the room look genuinely surprised. Acemoglu pauses, a small acknowledgement in the posture. Fine, take Ireland off the table. Let me give you better cases. South Korea, Taiwan, Botswana. Economies that industrialized or stabilized outside the Commonwealth framework entirely, through domestic state capacity, export discipline, and what the institutional literature calls inclusive institutions. The common thread across successful developing economies isn't the network they joined. It's the internal political settlement they achieved, the one that allowed property rights and investment to actually function. The Commonwealth can reinforce that once it exists. It cannot substitute for it when it doesn't. Ferguson steps back slightly, not retreating, repositioning. We're not arguing about substitution. Nobody claimed membership could replace domestic state capacity. The claim is that membership provided a compounding network effect, one that reinforced institutions where they existed, connected isolated markets, and reduced transaction costs across 60 years of commerce. A 21% cost reduction, compounded over 6 decades of trade relationships, is not noise. You're treating it as noise. I'm treating it as signal that accumulates. I'm treating it, Acemoglu says, as a supplement, a modest supplement. That's what the data shows. The variance inside the Commonwealth is larger than the variance between the Commonwealth and comparable non-member economies at similar development levels. That's the test that matters, and it doesn't come out in membership's favor. Silent. Not empty this time. Tight. Neither man moves. This is the moment the room realizes what's actually happening. They came expecting a debate about empire and prosperity. What they got is a debate about the unit of analysis. Ferguson was asking, what did the network leave behind? Acemoglu was asking, what actually explains the gap between rich and poor Commonwealth members? Those are not the same question. They were never the same question. And neither man is wrong. They're each answering something different and calling it the same debate. Ferguson's network effect is real. The 21% lower trade costs exist. The legal familiarity exists. The diaspora capital channels exist. They compound from a starting position. But the starting position, the nature of the colonial inheritance, the extractive versus developmental character of early institutions, the quality of the state that was left behind, that variable explains the overwhelming majority of the variance Acemoglu keeps pointing at. His critique lands there, and it lands hard. Acemoglu's domestic institutions argument is also real. India's growth story is a policy story, not a membership story. Pakistan's stagnation is a governance story, not a departure story. The high performers inside the Commonwealth succeeded because of what they built internally, not what they inherited from the network. What this means for anyone thinking about development policy today. Commonwealth membership is a real asset for an economy that's already built the state capacity to use it. It is not a substitute for that capacity, and it never was. Treating it as a primary explanation for success is a category error. But dismissing it as negligible undersells how a 21% transaction cost reduction compounded over decades of commerce actually works in practice. Step back from both lecterns. Stand in the back of the room where neither man can hear you. What you're watching is two people who both care deeply about institutions. One who believes the inherited network sustained them, one who believes the domestic political settlement built them. Both right, both incomplete, both answering a question the other one didn't ask. And that is the greater debate.
Let's invent again. In 1868, American railroads were killing people at a rate that would be unacceptable by any modern standard, and the railroad companies knew it. Trains couldn't stop, not reliably. Each car in a freight train had its own brakeman, a person literally sitting on top of the car, waiting for the engineer to blow a whistle signal, at which point every brakeman would manually crank their wheel, in poor visibility, in winter, at speed. If any one of them missed the signal, because of weather, because of wind, because they were too far back to hear, the chain broke. And on a long enough train, even perfect coordination couldn't help. The physics of sequentially applied braking meant rear cars would pile into front ones before the stopping force could propagate down the line. The problem wasn't courage or attention, it was architecture. Brake control was distributed across dozens of individuals with no common trigger and no ability to act simultaneously. And the railroads, for all their wealth and political power, had no answer. The person who solved it was 22 years old when he started working on the problem. George Westinghouse Jr. had just returned from the Civil War, briefly attended Union College, and already had a reputation as someone who couldn't leave a mechanical problem alone. He'd patented a rotary steam engine at 19. He'd invented a device to re-rail derailed freight cars. But the brake problem was different. It wasn't about fixing a specific failure mode. It was about redesigning the architecture of control itself. Westinghouse's insight was centralization. Instead of distributed brakemen waiting for a signal they might not hear, run a single compressed air line the full length of the train, connected to brake mechanisms on every car, controlled by one valve in the engineer's cab. When the engineer engaged the valve, every brake actuated simultaneously. No lag, no missed signals, no chain of bystanders failure. In 1869, at age 22, he was awarded the air brake patent. By 1872, he'd organized the Westinghouse Air Brake Company. The unexpected consequence took a generation to become fully visible, and it had almost nothing to do with safety. Reliable braking didn't just make trains safer, it made them longer and faster, because the fear that had constrained train design, if we can't stop it, we can't push it harder, lifted. By the 1880s, freight trains were running at loads that would have been unthinkable a decade earlier. That unlocked continental shipping economics. A barrel of flour from Minneapolis could reach New York cheaply and reliably enough to undercut local mills. A national commodity market became possible, not because of the steam engine, which had existed for decades, but because someone finally solved the stopping problem. The steam engine gave America speed. The air brake gave America scale. Westinghouse didn't stop there. In 1886, he founded Westinghouse Electric, brought in Nikola Tesla, and built the company that would eventually defeat Edison on alternating current. By the turn of the century, the various Westinghouse enterprises employed more than 50,000 workers. The arc of his career went from stopping trains to powering cities. But it started with a 22-year-old asking not how do we go faster, not how do we make trains more powerful, but how do we make them safe enough to trust? That reframe, from speed to reliability, turned out to be the question that unlocked everything downstream. This episode has been full of that same question dressed in different clothes. Nuclear reactors designed for 40-year operational lifespans over peak raw output. Forever homes built to last rather than to trade. Trade corridors built on 10-year infrastructure timelines. The air brake is the oldest version of the theme running through all of it. The infrastructure that makes everything else possible isn't usually the part that gets the credit. It just holds the rest of the system together while everyone else talks about the train. That's it for another episode of Wealth and Means. Advice dressed up like hard work.
We hope you enjoyed the arc. From nuclear reactors that just raised $1 billion to an air brake that stopped the runaway train, the economics of patient capital, and the mathematics of what actually compounds versus what only sounds like it should. The pattern was simple: build to last. Because first principles are rarely flashy, but they are usually where the future first becomes visible.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you, to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, agentweekly.ai.
Until next time, stay curious.
Stay kind.
And keep compounding.